Greetings, market rebels. Welcome to this week's sector situation. It is Sunday, April 14th, 2024. I think it's about quarter after 11 a.m. here on the East Coast. I'm Wayne. We're going to get right into it. I've got a few slides. I've got a flash, our trusty disclaimer, our trusty intellectual property rights notice, excuse me, and then this week's macro measure notes, and then last week's macro measure notes, just in case. So things did change quite a bit, and so you can see the difference in the notes there. And that's it for that for now, just in case anyone wants to go back and grab a screen cap. May mention some of those things. I'm going to briefly pause, and we're going to reposition things so they're out of the way. And then I can bring up my graphs for there's our graphic for the 12 sectors we normally start out with in sector situation. And so I did boost these up a little bit in terms of their magnification, and I'm not going to stay on here too much, but just a few quick points are that we really did see risk off. Virtually everything came under pressure or cracked some form of a trend line or support line. And some things are already very close to oversold. We're already there. XLV is technically oversold. You're getting really close already in XLRE and, of course, also in XLP, the staples. Even financials, which for the longest time would give nothing up, they are in the mid-30s. So you got to be careful, I think. You've got a lot going on. There's a lot of Fed speakers this week. There's still data coming into the EPS season. Clearly, the geopolitical with the Iran-Israel situation, who knows if that elevates from here, and so on. So that's the kind of quick backdrop, knowing that we've been preparing for the possibility that there would be some rough stuff in April and possibly May. Even sometimes if they caught us by surprise in March. I'm going to just jump really right into the main chart that's eluding me. Let's see if I can get I really want this chart here. Yeah, so I've got every sector pretty much ready for retracement levels, support levels. We'll cover those. I think I'm just going to talk about the levels since we did go to risk off. I think the one or two standouts that really haven't done much, I think, are XLK. That's a big deal. I mentioned this in macro measure. I think you've got the Mag 7 that's still kind of camped out. And again, probably the last line of defense. They don't really want to sell those because of the weightings and everybody owns them. And that really drags everything down. But you can see that XLK really hung on, not even close to even the 23.6% retracement level. So starting out with that one there. But bottom line is, where do you get back into this thing? And that's kind of tough, right? With the kind of noise we've had, you've got the 20 SMA up here in blue. But look, they busted through there. I would probably use this close, frankly. I think I'd use Thursday's close to wait until it got, in terms of feeling like I've got a really good daily trigger level. Certainly intraday, you could make a case for this, that, or the other thing with those charts. But if you're looking for, oh, they're surprising everyone again, and they're not letting the market fall, and they're actually rallying the market, something we just can't rule out because a lot of people, I think, are expecting there to be more of a drop. And these guys are tremendous at what they do, and they're great at just frustrating the living hell out of people. They did a lot of that actually this week in the market. But this would be this near the 23.6 retracement. There's the obvious gap. And the 100 will be coming in there. So that would be a normal, I think, solid spot to look for if we do crack the lows, probably looking at Wednesday's lows. You crack there, you're probably working your way down, would be like my thought. That would be my next kind of target area, right near the round number of 200, right near 199. Of course, there's other things we can look at, but that's got a little bit of confluence for those reasons. And so that's where I look for the corrective activity to make its way towards, if we see more of it. If you want to wait to get on better footing, you probably have to be through, because that is a very clear and deliberate high, and that is the highest closing high we've had in the last week and a half, maybe plus. That is probably where you're looking at on Thursday. So related to this, of course, is SMH. We already noted that the Mag 7 is also hanging in there, and XLK was the leader. SMH was the leader, and that also is hanging in there. Now, you could say, well, is it really? You know, some people I could see making that argument. I'm just making it the argument from this basis as to say, yeah, it's hanging in there. Hasn't reached the. I'm not sure what happened to the fib on that. Oh, you know what? I think that was an extension. Um, we should drop a retracement in here. I thought we had one in there. My apologies for this, but I'll try to get it taken care of pretty quickly right about there. I'm probably just going to tidy this up really quickly. 239.14, which is a high, and the low we're using is that wick from there, 136.10, excuse me. So there you go. So they're all actually about the same level. There's your 23.6. There's the golden 50. And so that would also be, right, a spot you would expect to see this thing trade down to if we do see more corrective activity. And you've got the 50 there, you've got the retracement there, you've got a flat line there where it did respect that level before. You can see Thinkorswim's fighting with me a little bit here. So I think that does make a lot of sense. And it's still held on to, right, more than 80% of its gains, more than 85% of its gains, which have been tremendous gains. I mean, it wasn't quite a double from there, but my gosh, you know, it was a heck of a move. And you again are using Thursday's closing high. I think if you want to be a little less aggressive, you could probably come into here and say, well, there's sort of a mini flat line forming. I'd rather use 228. You know, by all means, go right ahead. But I'm saying I'm trying to provide the most aggressive points to get in that are not intraday in the way that I look at things. So you're very clearly near key support right now that could lead to more selling. But once again, I would say that we're looking at 2 to 3% more. It's not, and I'm not saying it can't fall more. I'm just saying that as of right now, it would be a decent pullback to get to that point, and you'd have another 2 to 3% on top of what you've already experienced. But we have noted that this one particular line has been remarkable, and I'll just extend it out so everyone can see it better. But we had drawn this as part of a triangle, and really there's been this epic battle, like just above and below this line, with the price action, excuse me, respecting the line in many ways. It's just kind of one of those interesting things. So we were expecting there to be volatility and really a breakout or breakdown. There really hasn't been that, though, right? This is one of those times where your triangle didn't really lead to anything sustained. Now, granted, there can be head fakes before they do deliver something sustained, but it's really been just very noisy, and let's say it has a more of a random feel, up, down, all around, rather than a false breakout, false breakdown, and then reversal. But that's clearly hanging in there to me, and that's going to need to crack more. Clearly, semis will need to crack more to really signal that the leadership area is in trouble, and that might bring about more Mag 7 selling, and then you might really get a deeper pullback. If you don't get that, I think it's going to be hard for them to really smash this market down too much without there being some kind of a geopolitical situation that worsens things. So, by the way, we're not doing a victory lap. We don't do victory laps, but we did say we thought the whole rate story would potentially be in trouble, and that being rates lower sooner. That's been one of the main things we've been disagreeing with, I guess you would say, with the market, the way the market's had things priced, the assumptions the market seems to be have run on. But I do think that could come back quickly to where it would become more compelling of an argument if there really is a serious pullback here due to geopolitical fallout, that other things that happen, whatever the case may be. I covered the Jamie Dimon comments that were I don't think very good, uh, and so on and so forth in macro measure. But I don't want to belabor SMH, but it's an important one. Again, I think Thursday's close because if it failed from there and it couldn't break out of resistance at that point, it's telling you in the short run that's an area that matters. And if we just do a nice line to it, and then I'll make an adjustment on it, we can see that that's really where, for whatever reason, this resistance dynamic keeps kicking in along this declining resistance line like that. So it is what it is. That's why I'm saying that's the earliest I could really get excited about it in a big way, is if it could bust through there. So, but let's just hope we get some good movement right out of everything. There's other bigger problems in the world, clearly. So if we can just get some good movement to work with as momentum traders, we'll take it. Getting back into our sectors, let's jump to XLE, because we'll go in a typical order now that I've kind of did the tech semi situation. XLC, right? I would say, look, you're really looking for a breakout of the highest high. You have to recognize that this is incredibly strong, that it actually registered a new high on Friday and then just had this awful candle develop from there. So this has been another leadership area, but I think you can see that sort of short-term crack. The real crack will happen if it can't support at 23.6, I think. So I think it's good until then in terms of the intermediate term trend. The 20 days right above there. So just really in that 94-ish ballpark. It's only, again, everything's only like 2 to 3% away that we're talking about. But then I think you're looking at, there's other forms of support. There's 93 support roughly, right? There's 92 support and so on. But in terms of the visual aspect of the trend cracking, I think you have to say that it's probably this 94 puts that trend at risk of cracking. But we haven't gotten much of a retracement there. It was very overbought. You can see that it kind of cooled off leading up to Friday, and now the RSI has really gotten battered relative to where it was, because RSI now is coming in at a cool, crisp 65, excuse me, whereas given how relentless the grind was, it was at 84 rounded, right? So that's a real back off there. Again, I'd wait for a breakout there. If you want to get a little more aggressive with a new breakout high, if you want to get more aggressive than that, I think call it 97, let's call it 97.25 would be an area that, again, would be a little more aggressive than waiting for the highest high. So that's at least showing me that it's working its way through what was sort of support and resistance. At least there's a level there at respect that it's powering through if it gets through 97.25. XLC we covered. XLF, we're jumping right to another powerful one that had been working like a charm, much like energy. Both were working like a charm relentlessly. And I think our RSI reading up there was 72. The prior reading before that was getting up there. That was 78. So before it when it was just simply powering with very few sort of sideways type days and things like along those lines. But look, this thing also cracked, right? The JPM thing was, I guess, somewhat of a surprise. I have to say I am surprised by it, because the way they were buying, to some degree, I am surprised by it, because the way they wouldn't let these things go, and the way these banks have been, how well these banks have been doing, especially JPM, I really would not have expected it to not deliver the goods, but that's exactly what happened. But again, you got to follow these situations closely, and that's what I don't have time for. That's why I'm not really if I don't know what's going on, I'm not a big earnings speculator. You got to dive into a lot of stuff, I think, to really be informed about that stuff, which takes a lot of time. Anyway, next level's probably going to be near the 100, because I think there's a little bit of flat line sort of near there. And then that's down again 2.5%. The 100 would be coming in right there if it can't hold that 23.6 level. If it breaks through there, I think you're coming into the 100. We're talking about pennies because this is not a high dollar index. But remember, a lot of these things do have downside gaps that remain unfilled. Um, but overall, you still have rising SMAs. This thing is on the brink, though. You can see that. I do think it has cracked the most aggressive form of support we can draw. So you just got to wait and see where there's confluence. It doesn't have to stop at where there's confluence, but that's what I usually lean towards in favor, because there are a lot of there's it gives it more or a lot of more reasons to stop rather than just one level. But I think somewhere near that 100 day, if that 23.6% retracement doesn't hold, that would be my way of looking at that one. Getting back in, I think if you were to get in as a bull, you really got to at least get back above the 20 day. And I clearly you'd still be fighting the short-term downtrend with the way that those short-term SMAs and the price action itself is flashing right now. But 20 would be my number to get back in and feel like, okay, maybe there's something that's going to happen here. But again, you're probably not even all the way through resistance if it does do that. It's just an aggressive way to get back in. That 20 is at 41.35, so that's really up even 3% from here. So it would take a while. If you want to do intraday and be super aggressive, you could just say back above the 50. Gets back above the 50, I'm going to give it a shot to bounce. And probably if there's some, I think if there's some justification in terms of the news developments in the market, especially if they help financials, that would be maybe something to consider. But again, you have to wait for all this to materialize. Real estate, something we've been looking at saying, how's it hanging in there, right? How's this up there? We did see a little bit of bearish paper in real estate this week. We've seen a little bit trickles here and there, not a ton though. And there are plenty of downside gaps. You can see there's an arrow towards, back towards this one. There's an arrow here. There should be a oval or arrow here for it, but it does have those. And you can see this thing really never got back up. It's been struggling, couldn't take out with the market still roaring, couldn't go challenge the high from late last year. Now it's at risk of losing the 200 in purple. That's the last of them, of course, because it has been generally trying to hang in there and still is way above the fall lows. But you're at the 38.2 pretty much, and now you're probably on your way to the 50% retracement. And near there, if you look back over here to the left, near there, you'll see that if I just leave my line there near the 50%, let me get it on 50%. That also shows, I think, that the ETF respected that level at 36, let's say 40 before. So it's had a lot of action around that level that it seems to have respected. So that would be another reason to think that that could find some support if it continues to drop. As far as getting back in, I guess you could use the 200 in purple for now. Again, I would only probably feel very good about that if intraday, right? Kind of thinking like very aggressively intraday. And I'm seeing some news that maybe is a life raft for this market that could help it get back on safer ground. But that one's ahead of the other sectors to a degree, and it's got the 37 on the RSI right now. So that's why it is where it is. But I still think there could be plenty more downside there. Unless these rates start to come down, I'm not sure even how quickly that would help, but it might help. But another one that was doing great, and you could see that this divergence trading it looks great in retrospect, and sometimes it is great, but you can see how the indicators / oscillators were struggling over here at the second high. It just wasn't there. But if you were hell bent on saying, well, this thing's about to crack the trend, this healthcare sector is about to roll over, the gang really put you through the ringer. They didn't really give you much to work with for, well, from late Feb all the way until late March. So you almost got taken out with a new high there, and it barely failed. We're talking about pennies. But that's what happens when you kind of have the compound negative divergence. And then these guys are great at, again, forestalling inevitabilities, sort of, but it would be one way to put it. SMA's all rolled over, right? It made it down pretty much to 38.2 on the retracement, really almost to the penny, I think. So where do you look for it next? I think you really, like, this thing's really in trouble. You can see that it's gotten hit down to what are we on RSI here on Friday's close? It's 29, so you're officially oversold already. Probably ultimately, though, if there's more market mayhem, you've got to think that you work your way to the 50%, which is right near the purple 200 day. It's right near there. So I think that's somewhere between the 150 and Rust and the 200 is probably your next big levels, because that's all right near the 50% retracement anyway. This does look problematic, right? But even when you do get extreme, right there, at some point, if they start turning it around, even though it looks awful, you can still get a good bounce out of it. All you have to do is go back to the two deep oversolds on this view. This one clearly a nice bounce trade, and this one a nice bounce trade as well over there, for what it is, for what it is. But that's not really what we like to do. We do trade bounces, of course, but we really don't harp on those. They're not really our main focus. We prefer to trade with the trend and trade these breakouts when you have strong trending action. Right now, this is clearly broken down, though. But yeah, I think your levels are clear when the 50 and 200 match up pretty closely, somewhere in that ballpark. And since the 150 is at 136.49 right now, you may as well say somewhere between 136.50 and 135.50 is where I would expect there to be support. And they remember, the gang, if they really want to support it there, they often don't let it get quite there. So you have to almost sometimes just cheat your bids up, or if you're holding puts, you would be creeping your offers lower to get slightly less prices than you would ideally, or lower prices, I should say. But that's just part of the game. We just call it shave. I call it shaving. Just shave off a little bit from your ideal expectations, and knowing that these guys do stop things just shy of numbers and levels sometimes. Here's XLP. It's important we're getting into the consumer. This thing was doing really well, as you can see, now below the 50. This is the phenomena that I was talking about when it comes to this type of phenomena, where you break below a very important support level, like the 50 there in gold, and then you come back up to it, because after they have an initial plunge, they often like to put a bounce together and see if they can get back through there. And this one tried very clearly to do that, and it got rejected, and now it's sent packing again. Interestingly, right, it bounced from the 23.6 area initially, somewhere near there, actually just a little shy, as we were just talking about, and then they took it back up a little bit, but it failed. You got the short-term SMAs rolling over here in staples, and I think the 100 you have to respect, because it does seem to respect SMAs. We can see that in the 20-day really on the way up, which is pretty common. It did pay respect to the 20-day several times. But that's the thing. 100 would be the next, and then your 200, which dovetails with your 38.2 almost perfectly. That's your next level, I think, down. Now, granted, I do think there's a few flat lines. You could say, well, what about those flat lines? They're in there, and they're not chopped liver, so probably 72, 80. There's one near there. But again, we're just trying to talk a little bit big picture. Where could this thing get to next? And if you're wondering, well, why aren't you talking about it falling even further? It's not because I don't think it can. I just like to do things iteratively, where let's first get to here, before we really bank on something going all the way to here. It could, but I'd rather say, okay, now that it's fallen, what's it look like that it's fallen there? What's the rest of the market look like now that it's fallen there? What am I seeing in UOA now that these things have all fallen to sort of confluence zones? And then make a judgment on that, and then be ready to change my judgment, because that's what the market really demands of us. But that's what I like to do. Anyway, here's your all-important consumer discretionary, and not quite as bad in terms of the look versus XLP, because it didn't really break clearly below the 100. You can see they closed it. The little games they play, they closed it pretty much almost dead on the 100, 5 cents above. It did seemingly touch the 23.6 retracement, looks like they kept that 8 cents away. Again, like we were talking about a few minutes ago, with just shave a little bit off. But look, there's a big area there. I think there certainly are some flatline type supports in the midst of all this stuff that we look back on. So somewhere in here, we'll just ballpark it. I'll say it's at 174-ish. There's going to be some flat lines that kick in, support that kicks in near there if it falls that far. But if you're talking bigger picture, retracement type stuff, where's the dovetail? That dovetailing happens really at the 38.2 near 171. So if you want multiple forms of support, including flatline support, I would also add that's right about your level. So a little bit, I would, in other words, if I were short the stock, or in this case the ETF, I'd bid a little bit above there. If I think there's real support at 171, I'm probably 171.20 or 30 bid. If I'm selling puts that I'm long, right, I'm going to cheat those down respectively a little bit, depending on the delta, gamma, et cetera, relative to a 71.20 or 71.30. But it's clear that there almost everything came under pressure. Your big sectors like energy, financials, which were just powerhousing, and the important transports all took some kind of a beating. The transports were kind of our canary in the coal mine. They were not joining the market's party to make us feel better. We said it rarely gets much better than it was about, I don't know, 3 weeks to a month ago, would be my ballpark on my memory. And the only real reservations we had were IWM and XTN. Everything else was pretty much working like a charm, to some extent at least. But now, right, you've got sort of like this, almost like a triple topping type thing. You've got this possibility of breaking below the 200. You've already broken below the 23.6 retracement on this move up. This is still really in a consolidation that's, to my mind, is bullish, to be honest, because you've got really an ascending triangle here, and you've got the higher lows put in. That's the way that I look at it. But right, given what's happening in the market, we have to prepare for the next level. That to me, as it breaks the 200 in purple, it trades down to that 38.2% retracement. Again, there's flatline support right near there as well. So that would be a reason for that to work. Your next one down, I think there's going to be a little bit, you're going to have a couple flat lines that come in on the way down, but realistically, right above, it's really, to me, it's just right above the, I don't want to try to put an exact penny to it, but I'm going to say somewhere in that 74.25, which is really close to the 61.8%. But more importantly, this sort of rolling over harder, and it does have gaps as well. There's even a little mini gap, I think, right there near 77-ish. So this rolling over harder just isn't a good thing, right? Because we don't want to see the kind of like the lifeblood of the economy, financials in trouble, energy doing well because demand's great is one thing, energy doing really well because of energy market factors that hurt consumers, not a great thing. Transports, not moving product through the economy, not good. So this is a little concerning, to say the least, if you ask me, with a lot of those things not acting well. And as we saw, the XLY is hanging in there, but it's on the verge of more of a break too. So if the consumer just is saying, now I finally got tapped out, and we did show all-time highs in issues with credit cards and credit card rates and balances, and then folks not defaulting, but folks falling behind on credit card payments. I think it's all near record or at record. But clearly, materials, which were absolute juggernaut, I did start realizing that probably that part of this was that they were just sort of undervalued against the inflationary environment we've been experiencing. They finally gave it up, right, in terms of the kind of performance we saw. So the sellers got around to those. They were probably a victim of their own success because they had performed so well. They really, for them, right, they performed so well. And now they're back there off to just above the 23.6 retracement on that low. I've got flat lines at 89.45 on that one, and that must be from old data that matters. It just got extrapolated out because I don't see enough here to really work with. But this 50-day is clearly a big deal. Doesn't seem like there's a ton of support to go along with it, maybe a little bit, but the 50 is kind of in a no man's land between, 23.6 and 38.2. So I think really the 38.2 is, you know, do it incrementally, do it iteratively. 23.6 can hold, look to the 50, again, shave, cheat a little bit, and then drop down here. This would be just above a high, right near where there was a little congestion and pause on the way up. That would be right at the 38.2. The 100-day will probably be near there at the time. And so if you factor it all in, you've got a fib retracement, you've got a rising SMA, and you've got a couple tops that you'd be just above, and you've got a little bit of hesitation in the price. That's a nice little touch there. So that makes a lot of sense if there's going to be more selling for it to drop to there. Now, if you want to get back into it, I think you've got to use intraday on this one. And I know it's not a big trader, but I'm just saying if you're trading names within there. But, you know, again, I think you have to wait for more action to feel better about taking a trade on the bull side on the daily chart. We need to see more action develop. It'll be a reversal candle after maybe really getting oversold in the short term, or, you know, you could base it off of intraday, but I think it's going to be hard. I mean, I think you have to use the 20 for now, and that's up there. You know, it's not too high, because this doesn't move around a lot, but visually you can see that's a pretty big move to get back to the 20 in light blue. XLI, excuse me. XLI, this one's been also was a really almost matching XLB. We kept marveling at that with rates going higher and so on and so forth, but it was really a performer again for it, right? You remember these ETFs are not as volatile as your, say, things like SMH that can really get going, but that's still a very nice move to go from the mid 90s to up to 126, right? That you tack on 30-something% in 5.5 months. But it was doing great, refused to really crack. You can see that it cracked last week, right? You can see that that 20-day played a role in it. It finally couldn't really hold that. Now, you know, you're under pressure. It stops. Like you can see clearly there's a close, there's an open, there's a high from recent action right near there. There's even another open right near where it closed. So again, that's your flat, kind of like mini flat line forming, short-term flat line action. The 50 days is clearly your next level that dovetails again with a little bit of a flat line-ish sort of mini flat line that's forming there due to the prior action back in here. There's not a lot of help though for the 23.6. So this one to me with the gap down here, and I'll just drop a little oval in there for that. But this one down there at 23.6, not really having much to offer in the way of other forms of support. There are flat lines on the way down, but an area that looks interesting to me would be near this 38.2, because again, you're just above a high there, and you had a little bit of hesitation there as well on the way up, and even just this little dip here was just above there. So somewhere between the 100 and 38.2 would be a real, if you get a really strong downside action, that would be an area that I would think they would try to make a stand. It all depends. It's all circumstantial, though. It all depends on what news, how much gravity that news has, you know, how detrimental that will be, how many people are poorly positioned, how many people are, you know, completely caught off guard and about to panic. Depends on a lot of different things, but I mean, overall, it's still pretty darn healthy that you haven't even retraced 23.6%. So it is what it is. Again, I think you're using the 20-day to get long in here. I doubt anyone's trading the ETF, but you never know. Sometimes we do trade it, but yeah, I think you're using that to get long. You've got to at least get back above there at the moment. Now, if more price action develops, we might be able to put something together that would be a much lower entry point that we'd feel better about. But as of right now, I think no, I need to see more action unfold before I can really start drawing things that I have more confidence in on there. Um, right at the 23.6% retracement here in XLU. We're not really trading XLU. We just look at it as maybe defensive positioning. It's done really well. If you think about it, in the face of the rates rising, it's done really well for the last 2 months. So I was wondering, like, how are they doing this? Now that might just be defensive, more defensive positioning. Maybe it's other kind of developments in utilities. I don't know. Unfortunately, it's just another thing. I could say it about every sector. Don't have the time to follow these things closely anymore. I just don't have the time to follow the news and developments and get some research and look into all these sectors, unfortunately. But that's it. I mean, I think that's normally defensive, right? That sort of did get bid. It did sell off because they get around to selling a lot of things at times. But let's kind of move over to another area. So let's look at XH. I'll take a look at IYR actually. So real estate, we did see some put buying in here. We do have a bearish idea, I think, still intact. This thing's about to lose the 150 and 200 in rust and purple respectively. Downside gaps are there. Again, to me, like, this makes sense to trade lower with what's happening right now, unless things get so ugly in the market that they flip around and the Powell goes on a dove cut spree, kind of out of the blue, left field, whatever you want to call it. But that looks kind of rough. The charts have really, I think, taken a turn for the worse there, and this thing could be under pressure. I don't know if they'll get around to pressuring housing, right? Because that's been one of their sacred cows that they don't want to touch. But it finally did break below a line we thought was worth keeping on the charts. It did finally do that. It broke below the 20 in light blue. And now I could probably extend this up through here. Let's see where that comes out to. Uh-oh. I think I'm getting slow performance from Thinkorswim right now. I've got to do something about this. Let me see if I can just extend that out a little bit. Seems like it extended, but just kind of like left me high and dry. So there is a support level that'll come in right below the 50, I think, from that support line that's there. So look to that. Now, it would be good if we could dovetail that with a little bit of flat line, but I don't really see much to work with there. It's minimal. So if that doesn't hold, though, there's gaps in here too. And again, I don't really worry about them after 5 days. Once they transpire 5 days later, if there's no gap respect at that point, I just sort of forget about it until it starts working its way back down towards that. And so I would start factoring in a gap. Let's see if there's one like this one. If you start really getting down, you see the whole market going risk off, and you're really below the 100, and this thing's looking rough. Then I start thinking, okay, the oversold factor could help it close or nearly close the gap, but it's too far away right now for me to really factor that in. And anyway, this would be my level. I think if you hold 102, you're probably okay. If they start cracking 102, then it might open the door towards a visit to the 100. As far as becoming a bull, it would be helpful if you see for some reason rates start to change their tune suddenly. Maybe that's the Fed announcement, prior to the meeting. I don't know. That's rare, but it does happen. Don't know why they would do that. I think the situation in terms of the geopolitical issues would need to be worse by a large degree than where they are now for them to really start doing that. But XHB finally did crack that intermediate term trend, and it's at risk of cracking the trend again, the longer term trend with the 50-day at risk there. So That's what I would keep an eye on. Getting long it very hard. I think you probably have to wait for a reversal through to be super, super aggressive. Would be a reversal up through Thursday's high at 105.29. So if you think they're going to engineer that, then that might be your area. Let's take a look at I'm going to stay away from futures this week. We did look at XLE. I still think there's plenty of upside there, but we do know that it sort of lost its luster, and it probably could use a little bit of corrective activity. Let's look at XAU, the gold and silver index. And you could see that this was doing phenomenally well, but then it had that rough Friday. So again, another one that was getting really kind of overdone on RSI at that point, and then it finally backed off in a big way. So maybe that's because the dollar got bid. Not exactly sure why. Maybe someone just decided to do some profit taking after a tremendous run that it had. I don't know if we'll get the chart that I want here, but since we're here, let's give it a shot because Thinkorswim is running very slow for me right now. But no, we don't get the chart that I want, unfortunately. Let's do GC. We'll get the gold futures, but this is, if you haven't seen this before, we've been talking about this somewhere around the fall. I want to say September, October is when we really started to bring this back up again. We brought it up before, but we came back to it in somewhere in, I think, in Sep and but God, yeah, Thinkorswim's crushing me right now. I'm sorry about that. Let me see if I can just get this, but I'm not going to touch it if we get it back. But you can sort of see there's a little bit of a cup and handle look. If I could adjust this, it would be a lot better, but it doesn't want me to do that. So that cup and handle, again, we talked about that firing, and when those things fire, they're usually pretty good patterns, and they usually produce a pretty good move when they do fire. And this one, we started paying attention to it. Again, like I said, once it sort of started to improve a little bit, it dawdled around for a while, though, right near resistance, which is not uncommon. But then a couple months ago, when the UOA started showing up and we started seeing the chart possibly ready to break out, and we kind of know that inflation, right, has been roaring, we had to go along with it then. We kept getting questions about it, and for the longest time, we were just saying, no, we don't care, we don't care, we don't care. Remember, we don't care about it as a trading vehicle most of the time, but that's how we were answering that question. As far as caring about it, I've already been on the record. I'm long this in different ways. So as a hedge, that's really not something that I'm looking at as, hey, I want to be long this, but as a trader. But lately, yes, the last 6 weeks to 2 months, we've been looking at it more as a trader mindset, as well as, yes, you probably should have some. People will often say 5 to 10% of your portfolio. So I'm probably closer to 10% myself, but because I'm just a little bit, I think I tend to be a little bit more of a hedger than a lot of people. So, but I do think that this thing really could go, and it's already nearing the 100% level in terms of the fib projection at 25.48. You're not very far away from there in visual terms, and if it moves through there, I did see a lot of things start to come on about it where they're saying that this thing could really start to go in the eyes of some of these brokers, and they're raising targets. They're saying there's a lot of central bank buying. Here's your 10-year note yield, and you can see that this on the monthly chart does not look very, very impressive. Let's see if we can get a better chart on this, but I think this shows it better, the 5-year daily. If this thing's been intermediate term uptrending, but that's against this sort of downtrend, right? So is this just a corrective action of this? We don't really know yet. It could be, but there is a gap up here, and it would start getting pretty darn scary in this market if these rates did work their way back up towards, let's say, 4.8% yield on the 10-year. That would put it within striking distance of the highest high we've seen the last couple of years. And this is really when the market, when this rolled over, that really helped the market bottom out at that time and power up. But both stocks and yields have been rising this year. And I got to think that something has to give way a little bit more. And you just never can know what it is. But this thing held most of those recent gains. It's been sort of stealthily working its way back up. So we've been telling folks for the longest time to keep their eyes on this. I would tell everyone to do the same. It's very concerning that these things keep working their way back up. The flip side, which I'll end on, is that you may have a situation where if the world becomes more unstable and things get perceived to be much riskier, whether it's nonsense, real, we don't, half the time you don't know anymore, maybe even more than half the time. But if it's being reported that way and accepted by the market, that could be the thing that really helps the market to get Powell moving lower sooner. And that would be, right, the joyous celebration. That's what a lot of them want. So that's why I don't even want to get into it, but that's why nothing really surprises me. So anymore, it's hard to become, I shouldn't say nothing, but it's hard to get surprised about anything anymore, for me at least. But yeah, I think that's the one thing you got to think about, that if you start seeing something, I think that argument could start to get promulgated if this market really does take a beating. They'll start talking about, well, now Powell has no choice but to start bringing rates down lower. That's, I guess, a prediction that I'm making, even though I don't really want to frame it that way. But this is what I've seen many times. It's just from what I've seen many times before. These guys, they're addicted to lower rates and liquidity. And if they don't get it, they feel like they're being cheated. So they start clamoring for it, right? Almost like addicts, unfortunately. But I'm going to end on that. A lot of these things that we've been talking about, I guess, finally started coming to fruition the last week and a half or so. And now it's just about, you got to be disciplined, because really they don't let you just ever, or I shouldn't say ever, they rarely let you just straight line your way down where you just make a killing without breaking a sweat with your puts. It happens, has happened here and there, but it's rare. So you're still going to have to be a disciplined position manager, more than likely, would be my guess. So I'm going to end on that. I'm going to say thanks to everyone for tuning in. I do hope that you got something out of this in the macro measure video this week. Hopefully it'll help you out this week or some week in the future. And again, great conclusion to your weekend. Great week ahead. Trade smart, be disciplined, and we'll make it through the other side, and we'll be back in touch soon, webinars and so on and so forth. So thanks again for tuning in.